You know, an IPO, an initial public offering, always seems to hit the news with a ton of hype, right? But behind all those flashy headlines, it can be a pretty risky world for an investor who isn't prepared. So today, we're going to put on our detective hats. We're going to learn how to spot the red flags and decode an IPO like a real pro. Let's get right into it. This quote really just gets straight to the heart of it, doesn't it? An IPO can be a massive transfer of wealth. The big question for you as an investor is pretty simple. Which way is that wealth flowing? Is it going into a company that's actually going to create value for new shareholders like you? Or is it flowing out, straight into the pockets of insiders who know it's the absolute perfect time to sell? The stakes are really, really high. And this slide, well, it shows the risk perfectly. See, way too often an IPO isn't some golden ticket for the public. It's actually an exit strategy for the early investors. They use all that hype to cash out at the highest possible price, leaving everyday retail investors holding the bag as the shares start to fall. Our mission today is to give you the tools to spot the difference, to see the clues that almost everyone else misses. Okay, so every good investigation starts with one simple rule, right? Follow the money. So in our first section, that's exactly what we're going to do. We are going to find out where the money that's raised in an IPO is actually going. Our investigation is going to use two key pieces of evidence. The first one is the DRHP, or Draft Red Herring Prospectus. Just think of it as the official case file. Now, it's a huge document. We're talking over 400 pages that every company has to file before its IPO. And it details everything: their business, their financials, all the risks, and, most importantly, why they're raising money. The second tool is the con call, which is kind of like our ongoing surveillance, but we'll get to that a little later. So inside that DRHP, that official case file, the very first clue you're looking for is whether the IPO is a primary issue or an offer for sale, an OFS. Now, in a primary issue, your money goes directly into the company. It's used for things like expansion or paying off debt. That's a great sign. But in an OFS, the money goes straight to the early investors' bank accounts. Not a single rupee is used to strengthen the company. And this slide right here really exposes some skewed priorities. Take a look at this case file. The company's raising over 2,000 crores. They also have 500 crores in debt. But instead of using that IPO money to pay it down, the vast majority of it is an offer for sale. The shareholders are just cashing out. So you got to ask yourself, why would a company with heavy debt let insiders take all that money home instead of strengthening the business? It is a major, major red flag. All right, the next red flag you've got to watch for is something called engineered profitability. This is when a company that's been losing money for years suddenly, magically turns a profit right before its IPO. You have to ask, is this real? Is it sustainable profit? Or is it just some clever accounting to make things look good right before the public offering? And here is a perfect example. The headlines might scream, "Company reports 32 crore profit," but when you actually dig into the DRHP, you find the truth. The company's core operations were actually losing money. The so-called profit came from a one-time tax credit. See, this isn't earned profit, it's an illusion. It's an illusion created to fool investors who just don't bother to read the documents. So the big takeaway here is that the purpose of the IPO, whether it's to fund the company or to cash out insiders, is your first and maybe your most important clue. But a good detective knows the investigation doesn't stop there. An IPO is just a single event, but a business is an ongoing story. Now, it's time for the quarterly interrogation. Okay, so after a company goes public, its management has to host a conference call every single quarter to discuss the results. This is your secret weapon. Think of it as live surveillance, where you can hear directly from the people running the show. You can track if their story's changing, listen to their tone, and hear exactly how they answer the tough questions. It's where you find all the clues that are hidden between the lines. So what should you be listening for? Well, here's a quick checklist. First up, guidance. What are they promising for the future, and do they sound confident about it? Second, product mix. Are they selling more of their profitable stuff? Third, CapEx plans. How are they funding their growth? Is it with cash or with risky debt? And finally, just listen to their tone. Do they sound direct and in control, or are they getting evasive and defensive? Let's talk about product mix for a second. On one conference call, an analyst noticed a company's profit margins suddenly jumped, and he asked why. Management explained that it was all because of a change in their sales mix. They were selling a lot more of their frozen products, which just happened to have much higher margins. Now, this is an insight you would never get from just looking at a spreadsheet. It tells you that the profit improvement is strategic, it's not random. And the big insight there is that conference calls reveal the story behind the numbers. Okay, so we followed the money and we've interrogated management.
We know if it's a good business. But now for the final and maybe the most important question. Is it a good investment? It's time to crack the valuation code.
So let's start with a really common trap, the PE ratio. You see a company with a PE of 100 and you immediately think, whoa, that's expensive. But is it? The answer is, well, it depends. A high PE ratio is pretty much meaningless without context.
Just look at this. You've got Company A and Company B, and both of them have a PE of 100. Now, if you stopped right there, you'd probably think they're equally expensive. But, and this is a big but, Company A is growing its earnings by 10%, while Company B is growing at a whopping 50%. Suddenly, paying a premium for Company B makes a whole lot more sense, doesn't it? You're paying for all that future growth. You know, there's a great little ratio for this. It's called the PEG ratio. It's simply the PE ratio divided by the earnings growth rate. And this one number gives you all the context you need. Company B, with its super high growth, would have a much lower PEG ratio, which means you're getting a much better price for its growth. It's an absolutely essential tool for your case. But here's the thing about valuation. It's not one size fits all. You have to use the right tool for the job. Just like this slide shows, you use different metrics for different industries. For a bank, which has a ton of assets, you might use the price-to-book ratio to see what its assets are worth. But for a tech company, you'd use PE to value its earnings power. A good detective knows exactly which tool to use for which case. The lesson here is absolutely crucial. Valuation is all about context. A high PE isn't always bad, and you have to use the right tools for the right industry. We've covered a lot of ground today, so in our final section, we're putting it all together. This is your complete investigator's toolkit. So here it is. This is your checklist. First, the IPO interrogation. Is it a fresh issue or an OFS? Is the profitability real or is it just engineered? Second, your con call surveillance. What is management guiding for? How do they handle those tough questions? And third, your ratio forensics. How does the PE compare to its peers in its growth? And are you even using the right ratio for the industry? This checklist right here is your guide to a smart, informed decision. So, I'll leave you with this one thought. The next time a big IPO makes all the news, you'll have the tools and the mindset of a detective. You'll be able to look right past the hype, see the clues that no one else does, and ask all the right questions. The only question left is, what will you find? A genuine opportunity or a scene that needs a much closer look?